What is your name, sir?
Ryan.
Ryan. All right, yeah, that's right. I have to do that. Wait, hold on. Hold the recording. Hold. Pause. Alrighty, chapter 2, accruals and deferrals. Remember how I said it was going to make more sense? Let me leave the store right now, and I'll close it later. But remember how I said it was going to make more sense about this whole the cash flows. We want to know when cash flows, and the whole first chapter, cash was always flowing. Well, this is when cash stops flowing, but we still get to recognize things. So in this chapter, we will be learning about accounting for revenue and expense transactions that affect more than one accounting period because of timing differences between cash flows and revenue expense recognition, right? So again, just as a reminder, an accounting period could be 1 month, 1 quarter, or 1 year. So if, for example, this is a great example that I chose here. But if, for example, I did work in March, but I didn't get paid for it until April, right? Maybe because of the way I've got my things set up. Hello. What's your name? Akira. Hi, Akira. I just want to mark you present. So I got to write your name down. All right. Suppose a painting company signs a contract to paint a house. 2 weeks after signing the contract, a painter starts the job. The job is complete in 1 week. The company sends the client a bill a few days after the job is complete. The company receives payment from the client 10 days after the bill was sent. Should the paint company recognize the revenue the day the contract is signed, when the work was started, when the work was finished, when the bill was sent, or when the cash was collected? Well, that's what this chapter is going to answer. So, companies may recognize revenue in the income statement in a different accounting period than the period in which they collect the related cash. So, for the painter's example, if I painted it at the end of March, but I didn't send out the bill until maybe March 31st, and they didn't pay me, Vicky is here, and they didn't pay me until April, then that's a different accounting period if I, as a company, choose to close my books every month. So, companies frequently also make cash payments for expenses in accounting periods other than the periods in which the expenses are recognized in the income statement. Recognizing income. Oh my. It's Monday. Okay. Recognizing revenue when it is earned and expenses when they are incurred, regardless of when the cash changes hands, is commonly called accrual accounting. Okay? Most companies do accrual accounting. All right. So, accrual, in the part of the accrual accounting, is required by generally accepted accounting principles. Virtually all major companies operating in the United States use it. Its two distinguishing features are called accruals and deferrals. Okay, so the term accrual describes a revenue or an expense that is event that is recognized before cash is exchanged. Okay, so what do I mean by recognized? I mean that we're going to tell our books about it. We're going to do what's called a journal entry. Hello, sir. What is your name?
Joshua.
Joshua. You go by Josh or Joshua? That was Josh. Josh, yeah. There you go. Okay. So when we recognize it, so that's another term that you'll hear me say a lot, along with increase and decrease, right? So revenue or expense event that is recognized before the cash is exchanged. So for my painter's example, it would be me recognizing the revenue that I have earned before they actually paid me. A deferral is a revenue or expense event that is recognized after cash has been exchanged. So we're going to see lots of examples of that, but like prepaid rent. Any of you have a prepaid cell phone, right? You pay ahead of time and then you use it up. And then you pay again and then you use it up, right? So prepaid expenses or unearned revenue in there. Say for my painting example, what if we had signed a contract and the guy paid me ahead of time? Have I earned that income yet? No, I haven't. Right? So that is a deferral. I can show the cash coming in, but I can't recognize the revenue just yet. Alrighty. I love it. See, chapter 2, we get to go straight into the numbers. It's awesome. All right. Cato Consultants was started on January 1st, year 1. Of course it was, because it wasn't started on January 1st, year 2. But sorry, I'm just being facetious. When it acquired $5,000 cash by what? Issuing common stock. Remember? See, we were gonna do this like all the time. All right, so you guys totally know how to do this now, right? It is an asset source transaction. We're going to increase cash and we're going to increase common stock, which increases our stockholders' equity, right? We have our statement of cash flows now, right? Financing activity. Okay, $5,000 because cash flowed. All right, that one's easy. Okay, so, hi, Katie. All right, so during year 1, Cato Consultants provided $84,000 of consulting services to its clients, but has not yet collected any cash. Okay, so here's what's going to happen is welcome to the chart of accounts party, a new account called accounts receivable. Okay, one of the terms, the key terms that you're going to take away when you're reading your sentences, right? When you're like, oh, okay, these are all the events, the words on account, right? So remember, all of chapter 1, there was cash this and cash that, and cash was king, and it was great. But now in chapter 2 and going forward, you're going to have a mixture of cash and things that say on account. So when you see the words on account, that's going to set off alarm bells in your head going, oh, wait, this is special, right? So accounts receivable is an asset account. The balance of the accounts receivable represents the amount of cash the company expects to collect in the future. We provided $84,000 worth of services. Because I provided it already, right? This is an accrual. I'm going to go ahead and recognize the revenue. Okay? I earned it, so I'm going to recognize the revenue. Okay? So I'm going to increase my assets. I'm going to increase my revenue, which increases my net income, which increases my retained earnings. Okay? Accounts receivable is an asset. No cash flow, right? So NA for our statement of cash flows. All right. So then the miraculous, wonderful thing happens, and we collected $60,000 cash from customers and partial settlement of the accounts receivable. Okay, this is called an asset exchange, right? So my accounts receivable is going to decrease, right? I have less people that owe me, and my cash is going to increase by the $60,000. My assets are both increasing and decreasing, and I have my statement of cash flows operating activity for the $60,000. Okay. So again, these slides are good for when you have this particular sentence and you're like, they collected cash. What do I do again? Just come back here. All right. Cato paid an instructor $10,000 cash salary for teaching courses. All right. So asset use transaction. My salary expense is my expenses are going up. Therefore, my net income is decreasing. Therefore, my retained earnings is decreasing. Right? So in turn, my stockholders' equity decreases. It's like a long and winding path to find the answer to whether stockholders' equity is increasing or decreasing, right? My cash is also decreasing because I'm paying it out. Okay, I have operating activity for my statement of cash flows for $10,000. I don't even know if I'm in the frame. Hopefully I am. All right. Now, here's another thing. Maybe it's not. Cato paid $2,000 cash for advertising costs. The advertisements appeared in year 1. So, advertisements, you've got to keep an eye out. Sometimes it's prepaid items. Sometimes they use the whole thing. So, again, my expenses are increasing. So, my net income is decreasing. My retained earnings is decreasing. Therefore, my element stockholders' equity is decreasing. And, of course, my cash is decreasing. and it's advertising costs specifically for the business, so that is OA. Making sense so far?
Yeah, I think so.
It always makes sense when the teacher says it, right? It's when we go home and do the homework that it all just sort of falls apart. All right, at the end of year one, Cato recorded accrued salary expense of $6,000. So we are going to be doing what's called adjusting entries. So what's going to happen is there's going to be some things that we've accrued, like salaries, right? You know what that feels like, right? Because, your paycheck's always 3 weeks in the rears, right? So your boss is accruing the first week before, and they accrue the second week before they pay you, right? So when you're first hired, it's like 3 weeks. After that, it's like 2 weeks in the rears. So they have to accrue that information, set that money aside, and then they pay you with your paycheck and they put all that money back, right? So that's called an adjusting entry. So we are adjusting the books to reflect what we spent in terms of expenses. So they recorded the accrued salary expense of $6,000. The salary expense is for courses the instructor taught in year one. However, Cato will not pay the instructor cash until year two, right? That happens all the time. If you're working all the way up until December 31st, they don't cut you the check until, like, I don't know, January 5th, right? So we're in a different accounting period. Or again, if your accounting period is just a month. If you taught courses, if you worked for your boss, right, in March, and then you got paid in April, right? So what's going to happen is salaries payable. Anything payable, write this down. Payable equals liability. You're going to want to remember that because liabilities are increased and decreased with different things. So write that down. That is a trick. Anytime you see the word payable after an account name, that is a liability. When we hit chapter 3, you're going to want to remember that. Okay? So it is a liability because we owe somebody something, right? We owe them cash. We owe them their salary. We're going to go ahead and show the salaries expense. Okay? So stockholders' equity is going to decrease, right? Again, our expenses increase, which decreases our net income, which decreases our retained earnings, which decreases the element of stockholders' equity. We are increasing liabilities, right? We are something we didn't 2 days ago. All right. Did cash change hands? No, cash did not change hands. I'm not paying them yet. I'm just showing the expense. Yeah? Okay. So during the year, Cato signs contracts for $42,000 of consulting services to be performed in year two. This is one of those things, if they don't tell you that the person paid in advance for these consulting services, you just smile and nod and go, that's nice. I don't care. Right? This event does not affect any financial statements because nothing's happened. We are hoping that we will be able to follow through with this and that they will call us out and we will do our consulting services. But revenue is only recognized for work actually completed, not for work expected to be completed. Okay, so just because you sign on the dotted line and somebody's going to pay you $42,000, you're like, yes, I landed the big contract. But you don't get to take credit for any of that on any of your financial statements until you have actually earned that money and it's coming to you, right? So even if they paid you ahead of time, you're still not going to show that as revenue. All right, this little tiny dinky thing, like what? I mean, seriously. It's okay. I have a secret weapon. Oh, it's called rolling over my dress. This is terrible. Come here. All right. Which is cool because I get to sit. A secret weapon. Sorry, it's Monday. That's my excuse for everything. Everything, I'm telling you. I get to make it bigger. Okay, so this is the breakdown of all of the stuff that we've done so far. This is what it looks like in the accounting equation, okay? You guys are used to this. This was all of your chapter 1 homework looked like this. And this is what's a little different. So these are general ledger accounts. So the names should all be familiar, right? We've got advertising expense, salaries expense, consulting revenue, right? Retained earnings, common stock, salaries payable. Okay. So these are general ledger accounts or GL accounts, and it shows you the activity and the balance. Okay. Next chapter, we're going to learn about T accounts. So we won't see these exactly like this for very long. But this is basically like if you were to go to your job, and 500 years ago, I used to work as an accounting clerk. So I used to go into GL and I would pull information from them, and they would look like this. They would have, well, they would have the description of what was going in and out and why and who it was for and to. But yeah, so you will use something like this to do your financial statements from, right? So for your balance sheet, you're just going to look at the balances on each of these. So you guys will get used to doing that. All right. So prepare financial statements that include accruals. All right. So we have vertical statements. A vertical statement model arranges a set of financial statement information vertically on a single page, like horizontal statement models. Vertical statement models are learning tools. They illustrate relationships among financial statements. The models do not, however, portray the full formal presentation formats companies used in published financial statements. Okay, so here is our income statement. So look, what's the difference, right? What's the difference between chapter 1 and chapter 2? Chapter 1, everything was in cash, and so I would have only put 60,000 here. But because we're in chapter 2 and we're doing accrual accounting, we accrued $84,000 worth of consulting revenue because we did the work, right? So that's why we have 84,000 here. We did our salary expense. Now, what was our salary expense? It's 16,000. What is that comprised of? That's the $10,000 cash that we paid our instructor, plus the $6,000 accrual that we have that we're going to pay him next accounting period, right? So we're matching, and I'm going to get ahead of my slide, and I don't care. But we're matching. This is the matching concept. This is why we do accrual accounting in the first place, is we're trying to match the expenses to the revenues that the expenses help to create. Okay? Let's see. And then our advertising expense, $2,000. So our net income is $66,000. And then we have our common stock issued and our net income, and then our total stockholders' equity of $71,000. And then, of course, here we go. Accrual accounting revenue recognizes the revenue in the accounting period which is earned, even when the associated cash is collected in a subsequent accounting period, which I went over. Expenses include all sacrifices incurred to produce revenue, regardless of whether cash has been paid. These accrual recording practices will cause differences in the amount of net income shown on the income statement and the amount of cash flow from operating activities shown on the statement of cash flows. That's why your net income is going to be different than your bank balance. Okay? A lot of new business owners are like, well, my net income says I got this, but my bank statement is not anywhere near close to that. That's because in accrual accounting, this can create a difference in the amount of net income versus cash flow. All right. Oh, the statement of changes in stockholders' equity. Okay. It explains, and it's really funny because we do these statements like all chapter 1, and they wait until chapter 2 to tell you what they are. Okay. So what is the statement of changes in stockholders' equity? Well, it explains us the change in the amount of stockholders' equity during the period. It's kind of self-explanatory, right? It reports the effective stockholders' equity of issuing common stock, earning net income, and paying dividends to stockholders. But we've been doing that for a while, right? Okay, here's the balance sheet. So again, I have cash of $53,000. I have accounts receivables, $24,000 still left to collect. So my total assets are $77,000. I have a liability, salaries payable. I need to pay that, $6,000. Plus my common stock, my retained earnings from my net income, $71,000. Add those two together, and we've got $77,000. And again, here comes the slides going, let's explain that to them. So A balance sheet, again, remember, is a snapshot in time. So whenever you get to the balance sheet, you're going to go over to your T accounts or your GL ledger, your general ledgers, and you're going to pull the balances, okay? So it discloses an entity's assets, liabilities, and stockholders' equity at a particular point in time. It's a snapshot. So they had total assets of 77,000, which are equal to the obligations and commitments Cato has made to creditors and investors. Specifically, Cato has a $6,000 obligation to creditors. That's his. I know when we think of creditors, it's like we're thinking of a bank loan, but that person, that the instructor that did those classes, enabled him to be able to make money, right? So he owes that guy money for that. With the remaining 71,000 available to support commitments to the stockholders. Alrighty, vertical statement model part 3. All right, so here's our statement of cash flows. Okay, so here's another way that you might get tripped up. Okay, so when you're filling out your statement of cash flows, you're looking for where did the cash flow. Okay, starting in chapter 2, we're going to be dealing with something called T accounts, and you're going to have the cash account, so you'll be able to just focus on the cash account and what happened there as opposed to like literally reading all of the events again. But don't. So here we have the 60,000. Why? Because the 60,000 is what we actually collected, right? We would not be putting the 84,000 here. So the other thing you could do when you're in your homework is when you're doing that accounting equation, right? And off to the side, it's going to say cash flows. You're going to put OA, FA, IA, or NA, right? Or nothing. So just focus on the OA items, right? So don't get caught up. So there's the $10,000 for our salaries expense. So is the $6,000 here? No. How come the $6,000 isn't here? Just as a way of me quizzing you. Have we paid the $6,000 yet? No, we owe them. Cash did not flow. Okay? So we paid $2,000 for advertising expense. So our net cash flow from operating activities was $48,000. We did not buy or sell land. We issued common stock, and that's all we did. Net change was $53,000. We had a zero beginning balance because, of course, this was year 1, and so our ending balance is $53,000. Which, if you notice on your balance sheet, that is the cash account balance. And then they're going to explain it to us what is going on. Explain just the change from the beginning to the change in cash from the beginning to the end of the accounting period, right? Yes.
On the statement of cash flows, where did the 60,000 come from?
Where did the 60,000 come from, guys? From the revenue that was collected. Yeah. So I think that was event 3.
Okay.
I think that was event 3. It said that Cato. I'm going to pronounce that like 50 different ways. Don't even worry about it. The company collected. That was, what was that? Should we go back? Yeah. I'll race you. So they provided 84,000, and then event 3, yeah, they collected 60,000. Event 3, they collected 60,000 in cash. But what you'll do is, this is broken up, and I'm doing a lot of talking in between, so it's perfectly understandable that you're like, wait, where'd that come from? But that's a great question, because I always want you to know where my numbers are coming from. I don't pull them out of thin air, right? When you do your homework, you're going to have this whole thing filled in, and what you're going to do is when you get ready to do your statement of cash flows, you're just going to come over here and you're going to go, okay, pluck out the OAs, great, pluck out the IAs, pluck out the FAs, and it's going to make more sense. It's not going to be something that happened, 5 questions ago, and then you're like, wait, where'd it go? Mm-hmm. All right. So in the beginning, the cash balance was 0. By the end of the year, the cash balance was $53,000. The statement of cash flows explains this increase. Cato collected $60,000 cash, paid $12,000 for expenses, and acquired $5,000 cash by issuing common stock. All right. So just a little side-by-side comparison. The difference between cash accounting and accrual accounting. Or the cash flows, why you would see a difference. Right, so we already talked about this. They earned $84,000 in consulting revenue, but they only collected 60. They paid out 16,000, or they recognized $16,000 worth of salaries expense, but they only actually paid out 10, and the advertising expense was the same. So the net income with accrual accounting is 66,000 versus the cash flow, which is 48,000. Right? We are putting this here because we are going to get this money, or we're going to sure try. Right? All right. Oh, and then we're going into the accounting cycle. So there are 4 steps to the accounting cycle. Oh my gosh. Okay. We start by recording transactions. So those are the list of events that you always see. Then we're going to do adjusting entries. We're going to adjust the accounts, and you'll get lots of practice with that. Then we prepare the financial statements. Then we close our temporary accounts, right? Revenue, expenses, and dividends. The first step occurs continually throughout the accounting period. Steps 2, 3, and 4 normally occur at the end of the accounting period, right? So either all year long, you're recording transactions, and then in December, you're like, oh, we have our adjusting entries at the end of December, we prepare our financial statements, we close our temporary accounts, and then we start all over again. Okay, and again, they are taking something that we had started with in chapter 1, and now we're absolutely expanding it. So again, I told you that it is easier to remember what temporary accounts are as opposed to remembering which the permanent accounts are. So again, they're just reminding us the temporary accounts are revenue, expense, and dividend, and they are closed prior to the start of the next accounting cycle. We already talked about why they do that. Do they talk about it? Yes, they talk about it. The revenue, expense, dividend accounts hold information temporarily for a single accounting period, thereby facilitating the preparations of the annual statements. Okay? We just want to know, what did we make? After closing, the balance in the retained earnings account is equal to the amount shown at the year-end balance sheet. Okay? So we'll have practice closing. So for this chapter, you're going to have the transactions that you did in chapter 1. You're going to keep an eye out for the on account, and then you're going to have adjusting entries, and then you're going to have closing entries. So again, this is teeny weeny. So I will pull out my secret weapon. All right, so here are the closing. So if you notice, ADJ stands for adjusting. So you've got event 1, 3, 4, 5. The other thing to keep in mind is as you are doing this in your homework, you don't need to leave a space for number 2. You just load it in as they come in, right? So you're going to have adjusting entries and you're going to have closing entries. So it's going to say adjusting and then closing 1, 2, or 3, right? So we're transferring the balance from the consulting revenue account to the retained earnings account. We're transferring the balance from the salary expense account to the retained earnings account. And we're transferring the balance from the advertising expense account to the retained earnings account. Okay, so here's your temporary, they've got permanent equity and temporary equity. So we've got our revenue account. So for $84,000, that was our balance. We're going to close it out and bring it to a 0 balance. Same with our salary expense and same with our advertising expense. And then over here in retained earnings, you can see that happening. We started with a 0 balance because, of course, we were year 1. We closed, so we increased our balance to $84,000. Then we decreased it by $16,000 and decreased it again by $2,000. And look, there's our balance, $66,000, which handily matches with our income statement, doesn't it? Yes, yes. All right, any questions on the closing process? Fabulous. I know. You come in here and I stuff your brain full of knowledge for almost 2 hours. And you're like, what? Hey. I know. I'm not being very wise, so it's like rolling over my cup. Okay, the matching concept, which I talked about, right? Cash basis accounting can distort the measurement of net income because it sometimes fails to properly match expenses with the revenues that they produce. The primary goal of accrual accounting is to appropriately match expenses with revenue with the matching concept. And it's important to do that because, you want to know, are the expenses I'm incurring to run this business feasible? Does it make sense that I am spending this much money to earn this much money? Or am I not spending enough in expenses and if I did a little bit more, my income would go up? Or am I spending too much in expenses and I need to cut back? But if you're not ever matching the expenses that made the revenue, then you're not really going to know what's going on. Now, we go a lot more into that in Accounting 205, where you get to make those decisions. You get to decide, well, if I tweak this, what will that do with this? And that's kind of cool. So you'll hear more about period costs. We'll do some, but you'll hear more about it in 205. But expenses that are matched with the period in which they are incurred are frequently called period costs. All right. So that was like accruals and then like closing and like some other stuff. So now we're going to talk about deferrals. Cash may be exchanged before revenue or expense is recognized. Okay. In this case, the business defers the recognition. Now we are going to put in there that we got cash and where it came from. But yeah, let's talk about it. Okay. So the first thing we're going to do is we're going to go ahead and we're going to pay the instructor to settle the salaries payable obligation. So we're going to decrease salaries payable and we're going to decrease cash, right? We already recognize the expense. So this is the other thing. I don't want you to get tripped up. I don't want you to go, I'm paying somebody, therefore I need to put it in my expenses. Okay? So you have to remember, I already showed or I already recognized the expense last period. So the money that I'm going to move around is sitting out here in liabilities, okay? So that's why we have a statement of cash flows. It's OA because we actually paid the cash, but we don't have any expenses here. Does that make sense? Because that can kind of trip you up if your brain was already trying to connect, oh, salaries is always an expense. Anytime it's salaries, it's an expense. Well, no. Sometimes. No. Okay, so we're decreasing liabilities and we're decreasing assets. All right, so, and then we have supplies. And supplies is a different kind of beast. I was like trying to move the slides around because I didn't like how they were. But then I was like, oh, wait, that makes sense. So, supplies is an interesting thing. So this could be another one that trips you up. So, does anybody remember the special words that I gave you? The key words that I gave you to keep an eye out? On account. That's right. Cato purchases $800 of supplies on account. When I say that they purchased the supplies on account, does that mean we paid Staples? No, we didn't. Okay. It becomes a liability. I owe somebody something. Okay. Now, liabilities are not always I owe somebody money. I want you to keep that in mind. The connection I want you to make is it's a liability because I owe somebody something. Because we're going to have unearned revenue, which is also liability. But that's not me owing the money. That's me owing them my time or my service or my product, right? So when you think of liabilities, think of I owe somebody something. Okay. So I'm going to increase my accounts payable and I'm going to increase my supplies. Now, notice where supplies is located. It's an asset. Okay? It is an asset account. And these are the things that you want to remember too. You might want to create your own little chart of accounts, like put a little title, go assets, and then start listing out the accounts. Because depending on what kind of account it is, when you get to chapter 3, you're going to want to know what kind of account it is. I'm going to spoil it. No spoilers. No spoilers. But I'm just saying. Okay? So you might want to start creating your own little chart of accounts if you're like really good at writing notes and stuff. like assets, and then start listing, right? Cash, land, accounts receivable, and now supplies. You would add supplies to that list, okay? All right. And it would be accounts payable more often than it would be supplies payable. It'll tend to be accounts payable. Okay? No cash flows, so we have nothing for a statement of cash flows. Okay, are you ready for the tricky part? Here's the tricky part when it comes to supplies. Okay? Remember slide 33. Remember slide 33. Okay? That's what this slide number is. And I'm not doing the appendix stuff, so we've only got like 54 slides. So we're doing amazing, you guys. All right? So after determining through a physical account, it has $150 of unused supplies on hand as of December 31st. That is when they're going to recognize the expense. So it is impractical for a company to recognize their supplies expense as their supplies are being used up. Like, are we really going to recognize a 50-cent expense every time somebody takes a pen out of the supply closet? No, we are not. So what we're going to do is we're going to buy $800 worth of supplies. We're going to put it all in the supply closet, and then we're going to let the employees use it. And then we're going to go back in at the end of the year, and we're going to count up the supplies and see, okay, what's left. Now, up until this point, every time you saw a dollar amount in your events, that was the amount that you played with, right? The $6,000, that's what I'm going to put on my horizontal statement. So when it comes to supplies, I want you to be on high alert, because that $150, that is not what I'm going to recognize. If you notice, that $150 doesn't show up anywhere, okay? So again, this is me trying to break down any sort of little rules that you're putting in your head as to, well, if I do this, then that means this, okay? So when it comes to the word supplies, you're going to go, oh, wait a minute. I don't use the 150. I need the 150, but that's not what I'm going to journalize. That's not what I'm going to do anything with. What am I going to do with it? All right, we started with beginning balance of supplies was 0. We purchased $800 worth of supplies, so we had supplies available for use, $800. Okay? This sort of thing you're going to see a lot. You're going to see a lot of that when it comes to inventory, and you're going to see a lot of that in Accounting 205. So get used to the rhythm of I have my beginning supplies, I purchased, or I have my beginning balance, whether it's supply or inventory. I purchased, this is what I have available to use or to sell. Okay? That's the sort of dance. So they said the ending balance of supplies is $150. What does that mean? That means that whatever I do for this adjusting entry at the end of the period, the balance in the supply account must be $150 because it needs to reflect what's in the closet, right? So that means that supplies used was $650. We used $650 worth of supplies, so that is what we're going to recognize. So our supplies expense was $650, which then incurred, which lowers our net income, which lowers our retained earnings, okay, which lowers our stockholders' equity. So we're going to decrease our supplies account, and we're going to increase our expense account, which decreases our stockholders' equity. Now, no cash has changed hands still, okay? Supplies is kind of weird. So we bought supplies, no cash changed hands. We recognize supplies expense, and no cash changed hands still. Okay? Yeah, supplies is crazy. So slide 33 is your friend. All right. Now we're going to get into something called prepaid items, prepaid assets. Okay? This is the most classic example of a deferral. What are we deferring? We are deferring recognizing the expense. That's what we're putting off. So, for example, on March 1, year 2, Cato pays $12,000 cash to lease office space for 1 year, beginning immediately. Okay? Now, whenever you get into I'm paying in advance, When you say I'm paying for the year, one of the things that you need to keep in mind is what month did they start? Okay, they started in March. That's going to be important. They started March 1st. That's going to be important. Okay. All right. Deferred expenses are frequently called prepaid items. So we paid them cash. So we're going to decrease our cash and we're going to increase our prepaid rent. Prepaid rent goes under your assets column, right? So if you're one of those ones keeping track of where these accounts go, we're going to introduce a new account to the party called prepaid rent, prepaid anything, okay? So here's the trick. Just like I told you with liabilities, payable, if you see payable, it equals a liability. If you see prepaid, it equals an asset. Anything prepaid, prepaid rent, prepaid utilities, prepaid advertising, prepaid anything. Prepaid insurance, you'll see that a lot. You'll see prepaid rent, prepaid insurance. Yeah, most of the time. Okay? That means it's an asset. Why is it classified as an asset? Well, if we're leasing the building that we're doing business in, then that makes it possible for us to make money, right? That's why it's an asset. All right. So it's an asset exchange because we're increasing one asset and decreasing another. And we have our statement of cash flows, $12,000 operating activities, because this is for the business specifically. Okay? So the relationship between cost, asset, and expenses. Should I just read this thing? So we have the cost, and the asset deferred expense is prepaid rent, and then we show the rent expense as we use it. I don't like this thing. We're moving on. Here we go. All right. So when you see the word recognizes and it involves a prepaid thing, you're going to go, oh, yay, more math. I love the math. Okay. And again, some of the times, like these are equations and things that you might want to write down, like prepaid item, to figure out what you're going to do. So when you recognize the rent expense, this is going to be a year-end adjustment. So these are year-end adjustments. So this is another adjusting entry. So Cato recognizes rent expense for the office space used during year 2 accounting period. Wow. There's not a lot of information in there, is there? No dollar amount for me to go off of. Didn't tell me how many months, right? It just said, do an adjusting entry for the amount of time, the amount of rent we should recognize. Okay, so what's my first step? My first step is to go back to where it tells me that they prepaid it, right? Event 3, and figure out what month did they start it. March 1st. So you have to count March, April, May, June, July, August, September, October, November, December. I can't do 10 fingers. Okay? So I counted March. Try not to get in the habit of just subtracting stuff. Just count it out, right? Because it was March 1st. So you have to think all of March, all of April. Okay? So it was 10 months used. So what you're going to do is you're going to take the cost, the total cost, divided by 12 months. Okay? 99% of the time, you are never going to prepay rent like on January 1st. They're just not going to be that nice to you. All kinds of things are going to happen in all kinds of parts of the year. Okay? So it comes out to $1,000 per month. And you're like, cool. Then you're just going to take that cost per month and you're going to multiply it by the number of months used. And that is the amount of rent expense you're going to recognize. So you're going to decrease your asset prepaid rent and you're going to increase your rent expense. So the word rent shows up twice, right? Prepaid rent and rent, which decreases your net income, which decreases your retained earnings, which decreases the element stockholders' equity. So our assets went down and our stockholders' equity went down, or decreased. Now, no cash changed hands, right? Because we already paid. Note to self, whenever you're doing adjusting entries, you're never going to do those on, that won't ever be a statement of cash flows issue. Okay? All right, what do you think of prepaid rent? That's annoying, huh?
Yeah.
Yeah. Okay, unearned revenue. Remember how I said before that when you have a liability, it means you owe somebody something. Well, this is why I say something instead of you owe somebody money. Okay? Because it's not always money. Let's read all of the words. Cato receives $18,000 cash in advance. Another ding, 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 ding. In advance, in advance, in advance. Okay, that means something special. From Westbury Company for consulting services that Cato agrees to perform over a 1-year period beginning June 1st. Ding, ding, ding. Year 2. Okay? It's giving me a month. It's telling me that it's in advance, which means I'm probably going to have an adjusting entry, right? Okay. Have I earned this money that I received? No, I have not. So, from Cato's point of view, the deferred revenue is a liability because Cato is obligated to perform services in the future. I owe somebody services. I owe them something. The liability, welcome to the party, a brand new account, unearned revenue. That's going to go under your liabilities. So if you're keeping track of your chart of accounts, then unearned revenue goes under liabilities. All right, so we're going to increase our cash and we're going to increase unearned revenue. We did have cash flowing, so that's an operating activity, so we'll put that on our statement of cash flows. Here comes some more math. It's all about the math this time, right? So here's our year-end adjustment, right? So they're kind of flip-flopping, okay? I know we're flip-flopping between the event and then the adjustment because of that event, and then another event, and then the adjustment because of that event. In your homework, you're going to have all your events, and you're going to put them in, and then you'll do all your adjustments, and then you'll do all your closing interest, okay? So just because we're kind of flip-flopping, it's not how it's going to be in your homework. All right, so again, crazy sentence, right? Cato recognizes, adjusting entry, recognizes the portion of unearned revenue it earned during the accounting period. You're like, where's my dollar amount? Where's my information? Okay, well, just go back. Okay? If you forget, go back to the event and go, okay, wait, when, how much did they pay me? How long was it for? And when did they start? Those are the pieces of information you need. Okay? So based on the prepaid rent, and I'm sure half of you read half the slide already, what do you think we're going to do? Well, we're going to take that $18,000. They said it was for 1 year. It was a 1-year contract. We're going to divide it by 12 months. So that means we earn $1,500 of revenue earned every month. Okay? So how many months did we do it? Well, it started in June. Don't just go June to December. Oh, that's 6 months. Is it though? Is it really? June, July, August, September, October, November, December. Okay? All of June, all of December. Try not to do that subtracting stuff, okay? $1,500 per month times the 7 months that we did work for them, which means we get to recognize $10,500 worth of revenue. We earned $10,500 worth of revenue. So we get to recognize it on our income statement. Yay, us! Okay? So our liabilities go down and our revenue goes up, which makes our net income go up, which makes our retained earnings go up, which makes our stockholders' equity go up. Over to the hill and through the woods. To grandma's house we go, right? We already flowed with our cash. There's no cash flowing. Our cash account is not affected at all. Okay? How's it going so far? Yeah, kind of, sort of, maybe. All right. Oh, yes, and the teeny tininess. The teeny tininess of it. Okay, so again, I'm just going to focus on the adjustments. So the year-end adjustments, so we did a bunch of stuff in year 2. They also did a bunch of stuff too. They provided $96,400 of consulting services on account. Can anybody tell me what account we're going to be affecting if it says on account? Anybody remember? That was the first account I invited to the party. Mm-hmm. Yes, accounts receivable. So Cato paid $32,000 cash for salary expense. What two accounts are we going to affect for that one?
Salaries, expense, cash.
And cash. Not salaries payable, right? Because they paid cash. So it's just things you're gonna have to keep in mind. But we'll go through the homework again. So they paid $18,200 in a partial settlement of accounts payable. What would the two accounts be here based on this sentence? I know there's a lot of words on the screen right now, and I'm so sorry about that. If I paid money I paid $18,200.
Okay, the accounts payable decrease.
Yep, accounts payable, and what else? If I paid it, what do I pay? Cash. See, the word cash doesn't show up here, does it?
No.
It's mean and nasty. But if I paid, then that means I paid cash. I didn't write him a check. I didn't put it on a credit card, right? If you see paid, that means cash. All right, so then they have the year-end adjustments, right? So, terrible. Okay, so again, remember supplies is weird. After determining through a physical count that it had $150 of unused supplies, they recognized the supplies expense. Cato recognized rent expense. So again, you have to look. They recognized the portion of unearned revenue it earned, and then they recognized, so here's one more that we didn't do, $4,000 of accrued salary expense, right? So I'm going to increase my salary expense. I'm going to increase my salaries payable. But just because I love to show you guys tiny things, here's more tiny things. Okay, so here's our cash account. Here's our prepaid rent. So see how we had a zero balance and then we paid $12,000. Our adjustment to is $10,000. That's how much we recognized for rent expense. Let's see. Here's our unearned revenue, right? So we got $18,000 cash for a contract, and at the end of the year, we earned $10,500 worth of. So we still owe them $7,500 worth of services. Here's our supplies, right? We bought $800 worth, and we determined that there was $150 left. So we, oh my gosh, sorry, I'm allergic to math. All right, so we're recognizing $650 worth of supplies expense. Let's see. They haven't done any closing entries yet, just the adjusting entries. So apparently, if we look at supplies expense, they paid $32,000 in salaries, not supplies. And then we had $4,000 accrued. So the salaries expense balance is $36,000. Okay. All right. Lots and lots and lots of information there. And more teeny weenies. Okay, so again, these are just vertical statements, and it's showing you again how one feeds into the other. We are comparing year 1 to year 2 in these. So again, you started with whatever you ended with, ending common stock, you're going to start with the next year. Okay, that's very important to remember. If I ended with $5,000, I'm going to start with $5,000. Year 1, we made $84,000. We had $18,000 of operating expense. Our net income was $66,000. Year 2, we did good. We made some more money. We also made a lot more in expenses. So our net income is less than it was year 1, but we're hoping that Maybe these expenses are something that is going to help us grow even more in the future and maybe increase our net income some more. I would be looking at this as a manager. I'd be like, what was the jump, guys? And why did it not cause this number to jump by the same amount? Okay. Those kind of things that you'll start recognizing as you're reading these statements, which is going to be helpful when you do your group project. All right. So year 2, we issued more stock. So our ending common stock is higher. We have our net income. Oh, we paid out dividends. Hello. $21,000 in dividends. That was nice. So we have our ending retained earnings and our total stockholders' equity. And then our balance sheets. Okay, so again, I just, the slide before this one had ending balances, right? So you're just going to go, when you have to fill out the balance sheets in your homework, you're just going to go back to those GLs and you're going to go look at the ending balances. So this time we have supplies and prepaid rent and land. Alrighty, well, let's keep moving. All right, so then we have our statement of cash flows from year 1 and year 2. Looks like we bought land in year 2. Again, my ending cash balance is my beginning cash balance. So don't forget to do that. And then they're saying the $9,300 matches the $9,300. I know you can't see this, but in the cash account. Okay, so again, you can check your answers before you check your work. All right. Financial statement, vertical, blah, 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 blah. Financial statement users obtain helpful insights by analyzing company trends over multiple accounting cycles. We'd already started, and this is what I do. I'm sorry. This is what I do all the time. I move ahead. I start explaining stuff that other slides explain for us. But that just means we get to move through those slides faster, right? Yay. Yay for moving through slides faster. Okay. So again, we're analyzing trends. You're going to do a lot more of that in 205, but it's good to know a trend. It's nice to have year 1, and that's great. But year 2, year 3, year 4, year 5, like, are we trending upwards? Are we trending down? What are our expenses doing? What is our revenue doing? Are we taking on expenses that we don't need to take yet, right? So this just helps us to conserve space. We've combined all the expenses for each year into single amounts labeled operating expenses, right? So again, with your vertical statement model, you're just trying to get a snapshot view of what's going on. You just want a quick little view. We're not going to list out all the expenses. It is helpful eventually to list out all the expenses so that you can see what expenses are getting higher, right? So salary expense, we went from $16,000 to $36,000. That's a lot of money. That's $20,000. Who are we paying that to? What gold-plated desk do they sit at, right? So, and then year 1, so we had $10,000 rent expense, supplies expense, right? All right. And then we're going to close again, right? So at the end of the year 2 accounting period, the revenue, expense, and dividend accounts will be closed to the retained earnings accounts. After the closing entries are posted, the balance in the retained earning account is $84,250, which is equal to the amount of retained earnings shown on the year 2 balance sheet. After closing balances in the revenue, expense, and dividend accounts will be 0, which makes them ready to capture information that pertains only to the year 3 accounting period. Okay? Again, I want to be able to know what kind of revenue I'm making each year. All right. Slide 48 of like 54. Maybe I talked too fast. We're going to get done so early. All right. Classify accounting events into 1 to 4 categories. Okay. They are asset source transactions. Although businesses engage in an infinite number of different transactions, all transactions fall into 1 of 4 types. By learning to identify transactions by type, you can understand how unfamiliar events affect financial statements. Okay, so we have asset source transactions. So an asset account increases and a corresponding claims account increases. So that would be like an asset and a liability, or an asset and stockholders' equity, right? An asset use transaction is an asset account decreases and a corresponding claims account decreases, right? Maybe I paid off my supplies payable, or I paid my salaries payable, right? So my cash, my asset cash went down and my salaries payable went down, my liabilities. Asset exchange, one asset account increases and another asset account decreases when we purchased supplies, or yes. Mm-hmm. Claims exchange transactions, one claim account increases and another claims account decreases. Alrighty. And then we have the very, very last little bit. And then you guys are like, going to be out of here so stinking early. Oh, gosh. Whatever. It happens that way sometimes.
Yeah.
Yeah, I know, right? Go get lunch. Go get lunch before your next class. I'm laughing because I've only got like 4 or 5 slides left. All right. Discuss the primary components of environmental, social, and governance. ESG. It is the buzzwords for right now. Environmental, social, and governance is a framework used by analysts, investors, companies, and other stakeholders to evaluate the sustainability and social impact of an investment or a company. Managers are also embracing ESG as a way to manage risk, drive innovation, and bolster their reputation, right? Because in a world where a million different kinds of things, like you got Walmart, Target, and all kinds of stores that are the same, what sets you apart, right? You would learn that in your marketing class or your business class. What sets you apart from other businesses offering the same services or products as you do? And this is one of those ways that companies can do that. The environmental component of ESG reporting relates to a company's impact on the natural environment. Companies report on broad areas such as how they use energy and manage environmental risks. Depending on the industry, companies disclose information about the following areas: climate impact, the amount of greenhouse gases emitted and other energy consumption data; natural resources, the company's use of natural resources; pollution and waste management, the company's approach to pollution and waste management; and environmental innovation, the company's investment in environmental research and development. Are we being nice to the planet, basically? Or are we dumping stuff everywhere, willy-nilly? The social component in ESG reporting refers to a company's impact on society and stakeholders, encompassing employees. So there's a difference between a stockholder and a stakeholder, okay? So when you guys listen to the news and it's talking about stakeholders, you'll be like, I know what those are, right? So I'm going to tell you, but basically a stakeholder is anybody that has a stake in the business continuing. So a stakeholder in a place like Walmart would be, and I'm going to read this stuff and it's going to repeat it, but whatever, right? It's going to be the employees. They have a stake in Walmart continuing, right? Because they have a job. The consumers, the people that buy stuff, they have a stake. The surrounding area has a stake in Walmart continuing, right? Because if people come to Walmart and we put in a coffee shop next door, then maybe they'll go next door and buy coffee too, right? After they're done spending all their money at Walmart. Okay, so when people talk about the stakeholders, they're not talking about the stockholders, the people that purchase stock. They're talking about like basically everybody else. Okay, so right, customers, local communities, and suppliers. Companies report on their progress towards maintaining healthy, fair, and positive relationships with these stakeholders. So depending on the industry, they're going to disclose information about the following areas. So human rights, the company's policies and practices regarding human rights. No sweatshops, please. Yes. Employee relations, the company's ability to build and maintain positive relationships with its employees. Community relations, the company's relationships with its local community. Disclosures may include the number of employees hired from the community, philanthropy to local charities, community development programs, or local sourcing. customer relations. Oh, whoops. What? Oh, well, whatever. Okay. Anyway, I wasn't watching my screen. I was just reading. Yeah. So we have all of those, right? So customer relations, the company's interaction with customers, supply chain management, the company's management and transparency related to its suppliers. Disclosures may include data on the supplier's social and environmental practices, right? So it's, we know how it goes, right? Guilt by association. So if Walmart's supplying t-shirts, but they're using a sweatshop to do it, then everybody's going to boycott Walmart, right? They're not even going to touch the suppliers. So not only does Walmart need to be careful about its employee relations, but they have to think about their suppliers' environmental and social things. What are their suppliers doing? All right, last one, y'all, or almost. We're getting there. We're getting there. All right, the governance components in ESG reporting involves a company's approach to management. Companies report on their policies and procedures, as well as processes for decision making, risk management, and stakeholder engagement. Depending on the industry, disclosures include the following categories. So, structure and oversight, the company's process for establishing its board of directors, risk and compliance, the company's approach to managing risks and developing internal controls. All of Chapter 6 is devoted to that. Shareholder rights. Okay, so shareholder, stockholder, same thing. Do you own shares of stock in the company, right? The company's approach to shareholder rights and engagement, and business ethics, the company's pursuit of ethical policies and practices. So just like and this probably looks tiny, but just like in the food industry, you can get a grade, right? How many of you guys have walked up to a place and they got a B and you were like, nope. Or they got a C and you were like, why did I even step on your parking lot? Right? You better A or nothing. A or nothing. I ain't spending no money here. Right? So they can be, labeled the same way. Okay? So you could have BB to triple B to A to triple A. So you could go all the way up to triple A. So that's cool. All right. So those of you that are following along, the next thing is the appendix, and we are not doing that because there's all kinds of stuff in there that we cover in later chapters. So that means I didn't talk fast enough. Let me stop this